All right, happy Thursday. Get started here. Good afternoon. Welcome to the live stream. Those of you who know, through this live stream, you'll be able to chat and interact with professionals in the field of wealth management. You'll be able to ask questions, learn, elevate your knowledge of wealth management so you can be a better consumer of advice and better build your wealth and protect your wealth. Here with between myself and our guests, we have well over a decade of experience specifically serving high net worth individuals within wealth management topics. So as many of you have seen before, we'll have attorneys on here, we'll have a portfolio manager on here, we'll have myself, which is a wealth manager, and we bring different perspectives to you on a bunch of different topics. So today we're on our typical schedule where we're going to review the news very quickly. What are the headlines of the day? Watch a few videos. We'll take a look at the stock market, see what's going on in the markets in different areas and around the world in different asset classes, etc. See if there's any sort of narrative or anything interesting going on. And then lastly, we're going to cover a topic of the day, which today is what we call Advisor Alpha. Okay, so what is Advisor Alpha specifically, and what does it mean? Just to give you a bit of a preview, it specifically is a study done by Vanguard, which some of you might be familiar with, the company Vanguard. They're a big provider of exchange-traded funds. And they broke down specifically what's the value of having an advisor and what specifically are the areas that that value comes from. The reason I wanted to review that with you guys and bring it up as a topic is because of the fact that if you know exactly where the value comes from, you know exactly where to focus your questions, where to focus your attention, where to ask questions to make sure that certain areas are being covered for yourself. And believe it or not, something like just what types of investments or what specific funds are chosen are some of the lowest important topics from these findings, the lowest important areas. So I would say that to me was one of the most interesting things of these sorts of surveys and these sorts of findings, is because most questions we get even on the stream have to do with what specific investments do I place my money in, what specific funds, is this a good one or is this a bad one? And if you actually look at the data and the analysis, that's some of the least important factors in what can be delivered to you through by your own means, if you're a do-it-yourselfer, or through an advisor, through professional help. So I wanted to cover those things specifically with you guys for your information, and so you guys can be better equipped to kind of navigate and know what should be focused on, what is less important, what is more important. So that's what we're going to cover as the topic of the day. So stay tuned. I think you guys are going to be very surprised at some of the findings. I'll actually bring up the study itself, and we'll go through a key diagram of it that summarizes these points. So yeah, to anyone joining us, as our little stream here, live stream is expanding, we've actually opened up to YouTube, and now we're having a YouTube live stream component to this whole channel and this whole project. So I've provided a link to our channel, our YouTube channel, in the description. Please give it a click, give us a subscribe. It's a brand new channel. We're gonna try to build it up right now, and we're gonna be transmitting our Tuesday and Thursday streams to YouTube as well, not just to Facebook. So please go ahead, give us a subscription. Replays also get posted there, and they're more easier to find. It's more easy to find specific topics and that sort of thing. Highlights get posted there, so check it out, and I appreciate it. So yeah, like, share, subscribe, and yeah, so you could make sure you don't miss anything going forward. And just here real quick, right before we get started, for anybody that doesn't know, a bit of background: I'm a co-owner of an investments firm named Rushlight Investments, and my specific job there is private wealth manager for our clients. And what does that mean? Is a private wealth manager isn't your typical advisor in the sense of we just get a portfolio together after you filled out a questionnaire and I'll manage it for you. Well, that's not exactly what it is. A wealth manager keeps in mind a very large goal for your future, which might be retirement, inheritance for your children and preparing them for that inheritance, philanthropy, a combination of all of these things that and how they're going to make you happy, what you want to accomplish in the big scheme in the long term. So when you have that big goal in mind, there's a lot more that could be done. As you've seen with some of the conversations we've had with guests in terms of asset protection, right? That's a simple example where even if everything's done properly with your portfolio, if you don't protect your assets, a frivolous lawsuit, especially if you're a business owner or you're in a high risk position, could jeopardize everything that's done for that goal. So there's many things that come into play beyond just a portfolio and just maintaining it. When we're specifically focusing on what's your goal, how do you want to retire, what lifestyle do you want? Those sometimes are easy for people to answer, but giving them the confidence and the certainty in a central hub where there's a plan in a small couple bit of documents where everything ties together is my job. So keeping that big picture view in mind and making sure everything we're doing, from estate planning, asset protection, insurance, you name it, is all working towards that goal in a synchronized way, not just in isolation where I've done a little bit of, I have an insurance policy over here. Or, I spoke with an estate attorney over there. That's not synchronized. That's just doing maybe a bunch of good stuff, but not coordinated, which is very important. So that's just a bit of background on myself. And with that, let's get right into it. And by the way, I'm keeping an eye on the comment sections for the live stream. So if you have any specific questions on what is the value of an advisor, it's the topic of the day. We're going to cover the analysis and some studies that have been done on this. Have you ever been skeptical of the value? I know many people have shared that sentiment with me, and I totally understand where that comes from. And how many of you think it comes from the specific portfolio side, and what sorts of funds are chosen? I'd be very interested to know that. So yeah, I'll be keeping an eye on chat. Understand this is an interactive stream first and foremost. So in a moment here, we are going to review the news very quickly. We'll look at the market very quickly, but anything that you guys would like to talk about, we'll drive the conversation in that direction. So don't be shy. You're absolutely not interrupting. Fire away. And again, for anyone just joining, I've provided the YouTube channel link in our description. It's a brand new YouTube channel where we're expanding the stream beyond just Facebook Live. Please go on there, give us a subscribe. We post our replays, we post highlights. So stay tuned so you can get updates. And yeah, with that being said, let's jump right into it. All right. I'm gonna go here to the web scene. Let me switch over so you guys can see my browser. Okay, so I think this is something that's in a lot of people's minds, so I wanted to make sure we watch this video. It deals with will there be a double dip recession, right? Let's see what they have to say here.
There's a lively debate going on about whether or not the United States can enter a double dip recession. Now, the common thinking is, we're going to have the vaccine and everything is going to be better from the April-May period on as the vaccine moves through the U.S. population. And there's no question that there's a lot of truth to that. But that's April or May. What do we do between now and the first quarter? Arguing that things are good, we just saw the holiday sales breaking records. Negative is we're also seeing breaking records in COVID-19, taking down large swaths of the economy and shutting in numerous areas. That's going to be felt. So the answer is a mixture of both. Therefore, the question is, what do you do with it? And that is why there's open debate on the subject.
Wow, I love this video. And I'll tell you why in a second. For those of you who've been, it's going to be very obvious for those of you who've been watching a lot of our streams, but we cover a lot of news, and there's always a very clear stance portrayed by different stories. So typically when you see a video talking about a double dip recession, it's a lot of times someone making a case for, oh yeah, there will be, or no, there won't be, and here's why. And what we always do is we play devil's advocate here quite a bit when we're looking at news stories, because of the fact that there's always many ways to look at different issues, different events, different investments. A great example is Bitcoin, where there's billionaires and respected people participating in it and touting it as a good thing, and there's very many, just as many, if not more, people against it openly, saying, stay away, or I don't participate at all. So a lot of times when you'll see a story or coverage on something like that, it's very one-sided. It's a perfect example. It'll be somebody who's talking about, oh, this is the next big thing, you must participate in it, or other people saying about how the dangers of it. Where now in this specific video talking about the double dip recession as it relates to coronavirus, I liked how it covered both aspects, because that's the truth of a lot of these matters. There's compelling arguments to be made by very smart individuals on both sides of a lot of these issues. So the point I always make is you need to position yourself in a way that whether or not a certain issue is going to go one way or go the other way, you're still going to be protected, and you're not going to have high volatility that you experience in your specific portfolio. And a lot of people don't understand how to accomplish that. And there's a lot of professionals out there that are incapable of accomplishing that. But it's absolutely possible with all that financial markets have to offer. I talk about it quite a bit on here, where there's much more that goes beyond just mutual funds or just stocks and bonds, right? There's so much more. There's alternatives, which is an entire universe. There's other asset classes like commodities, currencies. There's different strategies that could be used in a tactical way, not all or nothing, to enhance and further diversify what you're doing. So when all of these different tools are utilized, you're so well positioned and so well spread out from a risk perspective, that whether there is that double dip recession or not isn't going to worry you so much, and you're not going to be freaking out. So what I really like about this is it posed a very good picture, or painted a very good picture about that there's a clear possibility of this, but is it for sure going to happen? No, it gave some reasons why there's a debate. So where do we go from here if there's a debate, right? That's a good question. And the answer is what I'm telling you. You need to be properly positioned, because there's always, on all sorts of issues, on the political issue of the elections that were just going on, there was a lot of talk about, X result, whether it's a Biden or a Trump victory, means this for the economy. And you'd find just as many smart people saying the opposite. So a lot of us that were thinking, oh, what should we do? What should we do? I was telling you, maybe you should shift the dynamic, because there's people on both sides arguing for and against what you're already thinking. And if that's the case, are you going to ignore everyone that disagrees with you, or are you going to prepare and be protected no matter what happens? The latter seems like a better approach to me, and it's along the lines of what I'm always touting here on stream. So I really like that video. I didn't expect that to be so balanced. We're typically talking about the other side of whatever they covered. So let's look at this slightly related to the last video.
Has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector, for women, and for African Americans and Hispanics. The economic dislocation has upended.
Hey, Michael, good to see you, man. Let me know if this is better. I'm not sure if you meant on the audio on the video or my own audio.
Many lives and
let me know.
Uncertainty about the future. As we've emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check. The rise in new COVID-19 cases, both here and abroad, is concerning and could prove challenging in the next few months. A full economic recovery is unlikely until people are confident that it's safe to re-engage in a broad range of activities. Recent news on the vaccine front is very positive for the medium term. For now, significant challenges and uncertainty remain, including the timing, production, and distribution, and efficacy across different groups.
Yeah, one of the things that he definitely mentioned here was dealing with the fact that not everyone has been affected the same way from the pandemic as not everyone has been affected the same way in general. We talked about a K-shaped recovery on here before, which means that not everyone, a V-shape, but then a K-shape, there's a leg that goes both up and down, because smaller businesses didn't really perform or recover the same way that larger businesses did. And a lot of them suffered and haven't recovered. So the V-shaped recovery that we saw in the overall stock market didn't necessarily apply to everyone, or didn't necessarily apply to maybe some smaller investors or some smaller businesses, smaller just individuals, right? Who might have been relying on a job that must be performed in person, and now they're not able to do that. Or when we're talking about lower income Americans, there's a shocking amount that live paycheck to paycheck, right? And when we're talking about them, if they weren't able to work for months at a time due to COVID, that's devastating. And as we'll take a look at the unemployment numbers in a little while here, where the unemployment still hasn't really recovered, although some areas of the stock market have more than recovered, like technology. The biggest companies in the stock market have more than recovered. So yeah, I would say that in general, that's the most concerning part to me as well. You need to properly position yourself, because there's so much uncertainty. Things haven't affected everyone the same way. And balancing your risks, like I was talking about in the last video, is something that takes a high level of expertise, where you need to find the right professionals. Please, again, everyone, never forget that's why I do these live streams. That's why I make myself available for just a conversation, a free consultation. I'm here for you guys. If any of these things are worrying you, absolutely, please reach out. I will say, in terms of news, we'll be able to see the rest of the headlines through this right here. We'll just very quickly go through the economic calendar, where this here tells us what's going on with different key numbers and key economic data that comes out. So here you'll see PMI, which deals with, it's an indicator that indicates its expansion or contraction in different areas of the market. So in manufacturing or sales or services. So if we look at how these numbers have been doing over time, we are a number under 50 typically indicates a contracting environment, and a number over 50 indicates expansion. So going into coronavirus, as we see these numbers, there was a massive contraction in April, May, June, July, but things started expanding as of late, according to this, these figures, the PMI figures, right? So September, October, November were the first readings for services above 50. And over here for manufacturing, if we look at that, let me close this. Manufacturing numbers, for example, in July, they breached the 50%. It's not percentage, it's just an index, it's just a number. So it was actually well under 50. It was contracting a bit before coronavirus, and it was a bit exacerbated by it. But ISM manufacturing PMI right there. We've talked about before when there's an unexpected event on the horizon and people want to know what to do. the reason it's very difficult to get ahead of some of these news or get ahead of some of these events is because the stock market always has an implied prediction in mind, right? And unless there's a big deviation or a change in expectation, there's not going to be a move due to that in the markets. So, as an example, if we know things are bad economically, and the numbers that come out confirm exactly what we expected, that's not going to have a big impact in the market compared to, let's say, if we expect the numbers to be fine and the numbers come out as a surprise very poorly. That's a shock. That's a change in expectation. So that's the fact that the market is forward looking is one of the key reasons why I discourage you guys constantly from, trying to play these events, because there's always a built-in expectation, and unless that expectation is turned on its head, there's not going to be some huge change or some huge shift or some huge opportunity to take advantage of. And you really have to keep that in mind. And that's why also having research and development at your fingertips where you can interpret, and professionals that can interpret news for you, is going to tie into the topic of the day. Advisor Alpha is one of the biggest ways you could save yourself not only heartache and emotional stress, but actual money, actual performance. Succumbing to some of these movements and these potential events as they happen is one of the big mistakes you can make, that the research shows over and over and over and over again. That key mistake and preventing that key mistake is actually related to the best thing in this research that we're going to see that a professional can do for you. Which is a quick spoiler. It has to do with what's called behavioral coaching. So, let's move on here. This is actually very interesting because there's a lot less foot traffic now in terms of retail sales and retailers. Look, watch this. Everyone's ordering things online now. You saw it. Online shopping jumped 44% this Thanksgiving, which is pretty substantial. Obviously there's pickups in online shopping during things like Black Friday, Cyber Monday, and leading into the holidays. People want deals, and they buy gifts, that sort of thing. But I thought it was very impressive that retailers are reaching their limits of allotted shipments, and there's holds being put on, which is going to affect shipping times, and sometimes customers get upset and they'll cancel orders and that sort of thing. That's going to be pretty interesting to see how this plays out. And I wonder what UPS is doing. I'm sure they're doing a lot to try to accommodate to excess volume, right? But it's funny how much habits are changing, that the decrease in foot traffic is leading to the things I haven't seen before, like restrictions on different retailers on shipments, right? So I think that's pretty amazing. And so yeah, so many habits are changing so quickly as it deals with COVID, right? I think we see it in the market where certain areas that exploded that weren't necessarily expected, but make sense due to COVID, like telemedicine, teleconferencing, Zoom, right? These sorts of companies that existed before but exploded in the coronavirus time. And I think it speaks to the importance of businesses and consumers themselves. They're still concerned about unnecessary exposures, right? Like if I could go ahead and shop from home and I don't need to go into the store, especially when there's coronavirus, I might feel a little anxious to get out, but I'm not going to risk it just to buy a gift when I could buy it from my house, and we feel the same way about services. So since 2015, 2014, when in the inception of my firm, we've been set up digitally, just by design for convenience reasons. But you need to be working with people who have that digital capability, and it's not new to them, so it's not going to be a disaster. Because we've all seen the hilarious videos of issues during working digitally or in meetings, and but from my perspective, what I worry about is things like cybersecurity, right? When some of these digital systems are designed quickly, I always fear for cybersecurity reasons, because that's a big component of how you design a system from the beginning. Back when we designed it many years ago, that was a key element, right? Because of the nature of our business. But there's many little decisions that could be made in building of these digital systems that compromise cybersecurity. So yeah, that's something that's also scary. We've seen headlines where the scams are at an all-time high as well, not just coronavirus cases. So yeah, here we have some news about K-shaped recovery. This is talking a bit about what I was mentioning, that for the upper classes, it's been a little less damaging because the overall stock market investments haven't suffered so much. But the areas of the economy where people don't have a lot of investment, and they might have been affected way harder by not being able to come into work, excuse me, and that sort of thing. It's sort of scary. And we've seen actually luxury goods providers have great months through coronavirus times and after, where other retailers not so much. That also speaks to the same issue, where it's not being the recovery isn't even across the economy, across different classes, lower, higher income, etc. So let's look here. Robert Frank's Twitter. I saw some cool stats that he posted where I think that where was it? I saw that the office space, it might have been another headline, office space vacancies in Manhattan has reached a point that it hasn't been at since 2003, which was slightly after the dot-com bubble bursting in 2000 and on. So that was quite concerning. I was like, wow, not just that there's been a lot of vacancy in people living in Manhattan. We've seen the explosion in real estate. We've actually talked about it on stream a few times. The explosion in real estate surrounding, the dense areas of New York. But also we saw what was happening with rents. A lot of people renegotiating rents because vacancies were so high. And seeing that the office space vacancy had hit a point that it hadn't been at since 2003 completely shocked me. So let's go on and move on to the actual stock market review very quickly, and then we'll move on to our topic of the day after that. And let me switch screens here for you guys so you can see my platform, and we'll talk about it. All right. Okay, so here we have a heat map of the S&P 500. Many of you have seen this before, What this shows is each box represents a company. The size of the box represents the size of the company relative to the other ones, and how green it is tells you how positive it is for the day, and how red it is tells you how down it is for the day. When it's this blackish color, it's close to zero. So here we see Apple, that's like this dark color but slightly red, is a down a 0.09%. Okay. So close to zero. And if we look at the overall market, let's see some of these indexes where gold is up a bit, bonds almost across the board seem to be up, and international stocks seem to be doing fairly well. The Russell 2000, which we've talked about on stream before, it's a collection of 2,000 smaller firms. So smaller firms are having a bit of a bounce back right now compared to the rest of the stock market. So the S&P 500 is up 0.14%, but the Russell 2000 is up a full percent, which is considerably more today. The NASDAQ is 0.25%. The Dow Jones 0.5%. Okay. So yeah, today's a relatively uneventful day in the markets. Nothing's moving extraordinarily up or down. Maybe besides the Russell, a 1% day is substantial. But yeah, this is interesting. And I love the heat map on a day like today where the market is relatively flat, because it's a great time to talk about diversification, right? So here we just kind of reviewed stocks, bonds, a bit of commodities. We didn't really touch on currencies. We didn't really touch on alternatives. But you understand that there's more beyond this, right? So an example of the diversification argument is, if you are someone who has a small collection of individual stocks, a day like today where a diversified portfolio is almost certainly up for the day, a long the market diversified portfolio, just be clear, is up for the day. If you would have chosen maybe some of the people who weren't particular winners today, you could be down on a good day in the market. And if you're down on good days in the markets enough times, it could really hurt your long-term outlook. And the same goes for a specific asset class. So if you're over-concentrated in stocks, or you're just within stocks and bonds and not participating in all these other things I'm telling you about, enough times where stocks and bonds together were down, where you could have not been down, or you could have been up because you participated in way more beyond that, it really starts damaging your long-term outlook. And in terms of the certainty of reaching goals, that is something else that gets highly affected when you're really damaging your results. Because, if you have a goal where you're going to be in retirement for 50 years and you're going to be living a certain lifestyle for 50 years, mistakes, good decisions, but also bad decisions start compounding. They start stacking on top of each other. So things like overly concentrated, things like not being spread out enough through all of what financial markets have to offer. These things are daunting. That's why I have the stream. That's why we talk about these things, to elevate your knowledge so you could better deal with them. But also, reach out. That's exactly what I do on a daily basis. I provide free consultations. I provide second looks. No pressure, just personally, I do those things because these things are very difficult. They're conversations that affect people for 20, 30, 40 years. So a lot of care, a lot of attention should go into them. One thing that I talk about all the time regarding second opinions is when you have a health issue and you're not sure if what's being proposed to you is the best route to take. A lot of people, it's very intuitive to find a second opinion, or maybe even a third opinion, or to seek out a very specialized person in the area in which they're having a problem and getting their opinion specifically. A lot of times when it comes to wealth, people won't take that approach. They might just deal with a couple different professionals as a way of diversifying, but getting second opinions, third opinions, trying to get some understanding themselves, asking the right questions is something that people do more naturally, I've seen, when it comes to evaluating their health. But when it comes to their wealth, some people don't put in that same amount of time and effort. And I think just routinely, you need to be doing these things because the environment changes. You know, what worked 40 years ago is funny enough not projected to be what's going to work in the next 10, 15 years going forward. And it's largely a function of, you know, global competitive environments, complex financial markets that change over time. So, you know, it's a tough environment. You really need to keep seeking out people. You know, anytime you have a doubt, get those second opinions, get those free consultations if you can, and try to make sense of all this stuff. Because, you know, mistakes over, like I'm saying, over a very long period of retirement, they start stacking up and they add up to a very substantial difference. So let's take a look at here. We did cover all the indexes. This is the Russell 2000 heat map that we're looking at here. As you can see, it is the index that is most up. Well, the broad index that is most up today is most green, right? We can see actually that maybe, you know, consumer discretionary, real estate, information technology a little bit, industrials a little bit are kind of the stronger areas, where maybe utilities, materials, healthcare is kind of mixed, are maybe the weaker areas within the Russell 2000, which is up today. That's kind of one of the cool things about a heat map, where if it's organized like this one is, where it groups together areas of the economy, right? We could see financials, utilities, consumer staples are particularly not shining points today. Communication services maybe as well. Whereas, you know, energy seems to be doing quite strong here in the bottom right, and industrials, real estate, maybe consumer discretionary are the stronger parts of the market. So if you look at the news of the day, you'll see some reasons for this stuff. No crazy moves though today. Yeah. We'll go ahead and quickly move on to the topic of. All right, so we're actually going to momentarily, I guess after, I'll give you guys a very quick introduction about what I'm going to talk about today in terms of the topic, and then I'll switch it to my screen where you can see the actual research paper, because I want to show you guys a specific part of it and share that with you. So let me switch screens. Okay, perfect. So what we're talking about is Advisor Alpha. So it's what can you count on a professional that's helping you with like a portfolio, let's say, on what benefits and are they going to bring to the table, and then let's quantify it, or let's look at what Vanguard did to specifically quantify the value, which means put a specific number on the value. The way they put a number on the value was they broke it into different areas and different functions that they could do for you, or should be doing for you, and what is the value of performing those functions properly over time, in percentage per year. What is it going to add in percentage per year over the long run doing different things? So it's very cool because it allows you to say, what's the highest value thing that could be done for me in terms of dealing with an advisor or dealing with a financial professional? I don't think those answers are very obvious to people. So we're going to take a look at what they found and how they arrived at some of these conclusions. And I think many of you will be surprised at what the total adds up to. actually over time of all these different functions added together. So yeah, let's actually jump right in so I could review each point with you guys. Let me go ahead and get rid of the schedule one moment so you guys can see the numbers, and I'll move this down just a hair so we can see all of the numbers. So look at this. Suitable asset allocation using broadly diversified funds or ETFs. So I'll translate in English. What this means is the actual distribution between maybe stocks and bonds using a mutual fund or an ETF that's highly diversified. So if we look at this, it's actually greater than roughly zero, but they're putting zero here because it's very unique to each investor to quantify this, A, and B, when you do this in the traditional fashion, you're going to match the market. So there theoretically shouldn't be much what's called alpha here, or added value here, from just simply doing this. So the very interesting thing to me is most people just believe that the key value offered by a financial professional is helping me decide the stocks and bonds and the broadly diversified funds, where that's not really what they found to be the most significant. And moreover, it varies a lot to each investor. So it becomes very difficult to assess that as an individual. And if the traditional approach is being followed, there's not much there to be garnered realistically, right? But let's look at some of these other stuff. Cost-effective implementation at 34 basis points. That means a 0.34%. Rebalancing at a 0.26%. Behavioral coaching at a 1.5% per year. Okay? That is the highest of all of the categories. And we'll review what each one means in a moment. Asset location, 0 to 75%. Spending strategy, 0 to 110%. Total return versus income investing. Okay, this is a specific strategy being followed. So what's cost-effective implementation? So there's a lot of similar funds, but not all funds charge the same expense ratio to provide you that service. So if you choose the most cost-effective funds, you could shave off or gain yourself a 0.34% a year. That's what that means. Rebalancing, which is something that not everybody does, just the practice of that has a specific benefit, and it comes out to 0.25% per year. A lot of people who manage maybe their own portfolios, they won't rebalance with the right frequency to get this amount. So that's why that's there. Behavioral coaching, though, that's what I wanted to talk to you guys about. Understand that this is the biggest factor that Vanguard found as a source of benefit from working with a professional. And understand, if you're a frequenter of this live stream, you will know that a lot of what we talk about in the news is how to think about things. Trying to coach you guys on this is the news. What does it really mean? How should we react to this? How should we behave as a result of what we're seeing? What are the don'ts? What are the do's in terms of the behaviors that you should be following in reactions to news, market fluctuations, life events, and how you may want to deal with them either emotionally or otherwise. So the behavioral coaching aspect is of pivotal importance, and Vanguard, through their studies, found that someone without behavioral coaching versus someone who is getting behavioral coaching, it comes out to 1.5% a year in just that one item, if done properly, which I think is very surprising to people, because everyone jumps to what we covered first, asset allocation. So, oh, what are we investing in, and what funds are we using, and how good are these funds, and do you vouch for them or not, etc. That's one of the least important things, in my opinion, especially when most people in our industry are following a traditional approach. So it's very standardized from person to person or professional to professional. So when that's the case, a lot of people want to focus on this right here. But the big kahuna is some of these other things. So behavioral coaching, if asset location, which I'll get to in a moment. What does that mean, right? So please allow this to sink in, because I think it's very shocking to most people, where they won't see this as the key area that is the most valuable in working with somebody, a professional. And secondly, I would urge you to consider whether behavioral coaching is a part of what you're receiving. Because just because that area will lead to a benefit of 1.5%, which is what Vanguard has found, doesn't mean that you're receiving it. Doesn't mean that everybody provides that. So please, when I was saying that today's topic is going to allow you to better determine if you're being served properly, what to focus on, what sorts of questions to ask. This is why I was saying that, because it's going to allow you to prioritize, wow, behavioral coaching, asset location, if that applies to me, or spending strategy, if that applies to me, those are very important. And then maybe things like, rebalancing and cost-effective implementation, also very important, but you can now prioritize and know what's kind of the most important and focus on those things. Make sure you're receiving those things. Work with somebody who focuses on those areas and gets you these value-added amounts over the long run for. Because what they found is, look, it adds up to about 3% in net returns. That's very significant over time. That's very significant. So just to talk about a couple other of these, though, to wrap up the list. Asset location. What this deals with is when you have different sorts of accounts, just to not overcomplicate things, you'll have maybe retirement accounts, non-retirement accounts. The tax treatment of these accounts is different. And what investments are placed in what account, because of the type of tax treatment, leads to a potential benefit if you do it in a smart way versus, in just a random, not a random, but if you just say, hey, this person needs X amount of stocks, Y amount of bonds, and you just do that across all of their accounts, you're not really utilizing asset location as a strategy in what you're doing there. Whereas if you know what the person needs, X, Y, Z, and then in an intelligent way, due to things like tax implications and other reasons, you put the assets in specific locations on purpose by design, you can garner a 0 to, that's if you don't have the ability and you don't have maybe a retirement and a non-retirement account. But if you have the ability and the vehicles, it could be 75 basis points, which is a 0.75%, almost a full percent, which is pretty awesome, pretty incredible. Just from asset location, that's a design level technique. It doesn't have to do with the specific choices of mutual fund. It doesn't have to do with how much stocks, how much bonds. It has to do with where we're putting them and why. So that's sort of a wealth management planning level, idea or strategy. Same thing with spending strategy. So for the same reason that asset location goes from 0 to a higher number, spending strategy deals with the same. You might have different assets in different areas, and as you need, if maybe you're in retirement, as you need to draw on these different assets, what specific places you draw from and in what order is going to have an effect on your overall wealth. So doing it in a smart way, from taking the big picture into account, that's exactly what a wealth manager would do, for example, allows you to get up to a 1.1% or so in extra return a year. That's massive. That's absolutely massive. So if you add just these bottom three things, the 1.5, 0.75, and then a 1.85, you get over 2.3% of this 3% in net returns that they found by three of what I would argue are the least understood by high net worth investors, normal investors, etc. A lot of what I see people are focused on has to do with 1 and 2 here, which is how much are the funds that I'm participating in costing me, which is a good question to ask, and what specific funds are being used, and how much stock, how much bond, that sort of thing. That's these first two, which don't add up to much given Vanguard's numbers here, although they say they could be unique from person to person, as a caveat. These bottom three, item 4, 5, and 6, pay close attention to this, because in my experience, many people do not. And right here is up to a 2.3% per year just from dealing with a professional that has that larger, big picture view for you and for your wealth and for your portfolio. It's funny, a lot of high net worth investors only need a couple percentage points to sustain their lifestyle, just by things that have nothing to do with the specific asset allocation, the expense ratios, rebalancing, some of this other more commonly thought of things. It can be the entire income needed right there. So that's how important it is. That just so you guys understand. So that's why I sort of wanted to review this with you guys today, because I found that many people aren't aware of this. And what I would ask you is, just because you're working with a professional, have you verified that they're doing behavioral coaching, asset location strategy, spending strategy? Because I've seen it many times where, somebody might be upset or might not be so happy with a specific investment. When they call the professional they work with, instead of getting some behavioral coaching, what will happen is, something to make you happy or make you not worry anymore. Hey, well, we'll switch out that investment that you're not happy with. Even if it's part of a larger plan, maybe they'll jump to appeasing the client versus behavioral coaching the client, which has to do with, how do we interpret this? Let's make sure we're doing a good decision. Let's make sure we're not acting in a biased way or based on emotion. Approaching these things and doing it with tact is what leads to that behavioral coaching benefit. That doesn't mean that everybody provides behavioral coaching. So understand that. And if there isn't a plan, so part of a wealth plan would include an area that talks about asset location. And if this benefit is going to be garnered, there would be an area that talks about this specifically. If there isn't, just because, maybe it's talked about or it was mentioned once in a meeting, doesn't mean it's being performed in your wealth plan. So what specifically is being done in terms of asset location? What specifically is being done in terms of spending strategy? Same question. If there isn't a specific area within a wealth plan to address that, there's a good chance that that benefit is not being garnered that you see here. It does say 0 to a certain amount. Okay. So please keep this in mind. And then the last thing that I wanted to leave with you guys is, this is a study of the benefits that an advisor can bring, right? But it's not saying the benefits that a wealth manager or a sophisticated wealth manager can bring. So one of the key themes, one of the key topics that we talk about is integrating with other professionals. So using other areas. At the beginning of the stream, I mentioned asset protection as an example. There's also estate planning. There's tax planning that can be done with your CPA. And these things aren't captured in the specific strategies that Vanguard lists here. These would be other line items. So working with other professionals to make certain goals are reached and get enhanced benefits isn't included here. So when you work with someone like myself, who's a private wealth manager that takes this large view into account, many of these things get included as part of a process, because when you take the 30,000 foot view, these things come into play by definition. But when we're talking now, one thing that we emphasize over and over and over again on the stream, which is integrating and synergizing with other individual professionals, like I was saying, the asset protection attorneys, the estate attorneys, insurance people, your CPA, and working on specific tax strategies. All these things lead to other benefits that aren't listed here, that can go beyond the scope of Vanguard's assessment of just, a typical plain Jane advisor, financial advisor. So, which almost seems like a dirty word in my opinion. So take this into account. If anybody would like to, I'll actually post it in the, anybody who's interested in checking this. Very interesting. This study by Vanguard, where I believe that not many people know about these things. And a lot of people tend to focus on maybe area 1 or area number 2, where what they found is those are some of the least important areas. So when you're trying to critique, when you're trying to assess how you're being served, please, I urge you, start thinking about some of these things that I mentioned that are lower on the list, that they found have much higher value. Behavioral coaching, asset location, spending strategy, these sorts of things. Beyond when it's something that we talk about all the time on this stream, wealth management, advanced wealth management practices where you integrate other professionals. Please check it out. A great example of integrating other professionals is the stream before last, where you could see it on our YouTube channel. Anybody who's not subscribed, it's in the description. Please subscribe and check out the videos. I have a highlight video of that specific live stream and that specific conversation, where we spoke with an asset protection specialist, an asset protection attorney. And we talked about the importance of working together, what happens when we work together, what that brings to a client when, as compared to not working together. And integrating other advanced professionals into a plan would be added to the bottom of this list and would enhance the value beyond what Vanguard studied. Like I said, this deals with a traditional, plain vanilla, just, what we would call a financial advisor. Not a wealth manager. So, yeah, that basically sums it up for today. I really thank you guys for being here. Again, link is in the description to our brand new YouTube channel. Please subscribe. We're gonna keep broadcasting the streams to both YouTube and Facebook, because our typical audience and those who know about what we've been doing here on Facebook, but in the future, we hope to grow the YouTube stream and grow the YouTube channel. We're going to have more professionals in the future in other areas, and professionals are going to come back again, like our asset protection specialist. And I'm going to go ahead, switch screens here for a moment while we wrap up. And yeah, again, thanks for being here. This was our Thursday stream. We'll see you back on Tuesday of next week at 12 noon Eastern time. And again, remember, this is our casual interactive space where, for an hour each stream, we provide commentary on the markets, on news. We provide our insight and answer questions that you may have live. Anything you want to know about, please post it in the chat. Be happy to talk about it before or after the stream. And follow the link to our YouTube. Please like and subscribe. Contact information is on the screen now, and you feel free to reach out to me via email. Thank you, and we'll see you again soon.